Good morning, good afternoon, and good evening, depending on where you are. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled, What to Expect in Banking Regulation in the Second Half of 2022. My name is Matt Bisanz, and I'm a partner in Mayor Brown's Financial Services, Regulatory, and Enforcement practice in Washington, D.C. I counsel financial services firms on a variety of regulatory and risk management issues, particularly in the banking sector. First, one or two housekeeping items. As regular listeners will know, this call is being recorded. We will email an audio link to all participants in case you wish to listen to the teleconference again or forward it to colleagues. In addition, the recording will be available as a podcast. As we will not have a Q&A session today, please send any questions regarding today's topics by email to gfm@mayorbrown.com and we will respond promptly. This email address also can be found on your invitation. Joining me today is Mayor Brown partner Jeff Taft and associate Kerri Webb. Jeff is a partner in Mayor Brown's Financial Services Regulatory and Enforcement Group. He focuses his practice primarily on bank regulation, bank receivership and insolvency issues, payment systems, consumer financial services, and cybersecurity and privacy issues. Kerri is an associate in our Washington, D.C. office and also is a member of our Financial Services Regulatory and Enforcement practice. With that brief introduction, we will now begin today's discussion with some thoughts from Kerri on the CRA and climate change. Kerri, over to you.
Thanks, Matt. To start us off, one major development in banking regulation over the past few months has been the joint proposal to modernize the Community Reinvestment Act, or CRA for short. To give a brief overview, the CRA was enacted in the 1970s to encourage banks to meet the credit needs of communities where the bank does business, particularly low and moderate income communities and small businesses and farms. The CRA is implemented by three banking regulators, the Federal Reserve, the OCC, and the FDIC. The banking regulators conduct periodic assessments of each bank's compliance with the CRA. Typically, these assessments are performed every 3 years. The bank receives a rating ranging from outstanding to substantial noncompliance. The regulator also releases a public evaluation detailing how the bank achieved or did not achieve compliance. Poor CRA ratings can have negative impacts, both reputational and legal. For example, a bank with a poor CRA rating may be limited in its ability to open new branches or merge with another bank. On May 5th, 2022, all three of the CRA regulators issued a joint proposal to modernize the CRA regulation. These are the first joint comprehensive updates to the regulation since 1995. The joint proposal comes after the OCC promulgated its own solo updates to the CRA, but rescinded them about a year later in favor of developing the joint proposal with the Federal Reserve and the FDIC. I'll briefly touch on some of the more significant changes in the newly proposed rule. First, the regulators proposed revising the community development definitions to clarify eligibility criteria and formalize guidance provided in the interagency questions and answers. The regulators plan to develop and maintain an illustrative, non-exhaustive list of example eligible activities. While these changes may bring more clarity and may expand the universe of eligible activities in some ways, it is possible that activities currently considered eligible may be excluded under the new regulation. There are also significant changes to assessment areas. Under the current regulation, banks are required to conduct activities in assessment areas based on physical locations of the bank's branches. For large banks, the proposed rule adds new assessment areas based on the bank's lending activities. In addition, large and some intermediate banks will also be required to conduct activities outside of either type of assessment area. Another change is to the assessments regulators will perform. While the lending test under the current regulation is largely the same in the new proposal, the service and investment tests are replaced by a retail services and products test, a community development financing test, and a community development services test. The newly proposed rule has several important implications, particularly for large banks. Large banks are subject to the most complex and rigorous requirements under the proposed regulation. Namely, only large banks are required to meet the requirements of all 4 tests and must comply with the most extensive data collection and reporting requirements. As proposed, the regulation creates new assessment areas in areas where the bank has originated more than 100 home mortgage loans or 250 small business loans for 2 consecutive calendar years. Further, banks will be subject to an assessment of activities outside of its assessment areas. These provisions seem aimed at prior criticisms that the CRA did not adequately address underbanked areas or reflect the development of online banking, which is not necessarily dependent on physical branches. Under the current rule, a CRA rating can be lowered based on evidence of discrimination or other illegal credit practices. The proposed regulation appears to permit regulators to downgrade a CRA rating based on any illegal practice. Further, the proposed regulation no longer expressly requires regulators to take a bank's remedial actions into consideration when downgrading the CRA rating. Implementation may also be fairly quick. Under the proposed rule, data collection and reporting requirements would kick in 1 year after publication of the final rule, and the regulators would begin using the new test and assessment criteria and assessments starting 2 years after publication of the final rule. Comments on the proposed rule are due in early August, and we will soon see how these comments influence the final rule. Another significant ongoing development in banking regulation in the U.S. has been commentary and proposed guidance from the banking regulators on managing climate-related risks. In late 2021, the OCC drafted principles for managing exposure to climate-related financial risks. Then in March of this year, the FDIC followed with its own almost identical set of principles. Both sets of principles were heavily based on the Basel Committee on Banking Supervision's proposed principles for climate risk management. Another financial regulator that took action recently was the FHFA, which released a strategic plan in 2022 that for the first time included an objective focused on identifying options for incorporating climate-related risk into the governance of Fannie Mae and Freddie Mac. FHFA also released a request for information on how the mortgage industry may be impacted by climate change and natural disaster risk, as well as how to best identify, assess, and respond to those risks. While the Federal Reserve has not taken action yet in the form of guidance or regulations, Federal Reserve members have made statements indicating that the Fed is developing scenario analyses to model climate-related financial risks and may integrate climate risk into stress testing requirements. As I mentioned, the draft OCC and FDIC climate principles took from the Basel Committee's draft climate principles. Last month, the Basel Committee finalized these principles for managing and supervising climate-related risk. The OCC and FDIC may look to the Basel Committee as they finalize their own principles. And so the finalized Basel Committee principles may be a good indication of where the OCC and FDIC may be headed. While there are no new regulatory requirements specific to climate-related risk, banking regulators are finalizing guidance on the applicability of existing requirements to climate-related risks and regulators' expectations for how banks can manage this risk. Regulators may soon be asking banks about their strategies for managing climate-related risks. And while we cannot know for sure, it is almost certain that banking regulators will continue to publish new guidance on how banks can manage climate-related risk. The current guidance from U.S. banking regulators focuses primarily on how bank boards and management can appropriately govern climate-related financial risk, as well as risk management practices. It is unclear whether regulators will impose more controversial measures, such as capital add-ons. There has certainly been political pushback on the idea that that regulators could impose measures like capital requirements. For example, Sarah Bloom Raskin recently withdrew her nomination to the Federal Reserve Board after congressional representatives questioned whether she would encourage the Fed to impose climate-related policies. Around the same time, Treasury Secretary Janet Yellen stated in an interview that it was too early to contemplate adjusting capital requirements in response to climate change, and that regulators must first evaluate the risks posed by climate change. This is certainly an interesting area that we will continue to see developments in. Now I will turn it over to Jeff.
Thank you, Kerri. I'm going to talk about two things today. First, I'm going to talk a little bit about Federal Reserve master accounts, and then I'm going to talk about the FDIC's advertising rules. With respect to master accounts, I have to admit I've been a bank regulatory lawyer for over 25 years and never spent much time discussing master accounts or Federal Reserve Bank services until the last few years. There's been a significant increase in focus on Federal Reserve banking services and master accounts in the past few years. There's been guidance from the Fed, there's been litigation, and there's also been proposed legislation all around this topic. As many of you know, the Federal Reserve provides various services to banks, and the banks can establish relationships with Federal Reserve banks, and all the debits and credits resulting from their use of the Federal Reserve services are basically booked through a master account. So the master account obviously has significant value to the financial institution and their ability to clear and settle payments and things of that nature. In early 2022 this year, the Federal Reserve proposed some revised guidance for evaluating applications for Federal Reserve services and master accounts. And the proposed guidelines established 3 tiers of institutions effectively as to the level of scrutiny that they would get when applying for these types of services from the Federal Reserve banks. The first tier was federally insured institutions, so typically your depository institutions that have FDIC insurance. They're in the first tier. The second tier was those institutions that are not insured but have a federal regulator, so think of a non-insured OCC trust company or somebody like that. And then the third category of institutions were the non-insured institutions without a federal regulator, effectively. So think about uninsured state trust companies. The Feds asked for comments on this proposal, and there were a number of comments, obviously, that were submitted. A couple of the comments I think that kind of stood out when you look at them is, one, a number of commentators asked that there be a time frame upon which the Fed would act upon applications or requests for these services. And second of all, folks questioned whether the tiering structure that had been put in place had some sort of an adverse impact or effect on the dual banking system we have in this country, because institutions without a federal functional regulator or without a federal charter, without federal deposit insurance, obviously we're going to be subject to additional scrutiny under the standards, and I think a number of people raised some questions about that. Obviously, when a bank is looking to get Fed services or a master account, they basically request the Federal Reserve Bank, one of the reserve banks, to consider their request. There's litigation now which is involving applications that haven't been resolved by the Fed. The degree of discretion that the Federal Reserve banks may have or exercise with respect to the application process or the timing or not timing of any sort of denials of those requests for information. In particular, Custodia Bank, which is an uninsured Wyoming depository institution, which is chartered as a special depository institution designed to connect digital asset companies to the U.S. payment system. Custodia, as part of their operations, applied to open a master account with the Kansas City Federal Reserve Bank in 2020. They also applied to become a member of the Federal Reserve in 2021. As of June 2022, neither the Federal Reserve Bank of Kansas City or the Federal Reserve Board had issued any decisions regarding Custodia's applications. Hearing nothing from the Fed in June of 2022, last month, Custodia sued the Kansas City Federal Reserve Bank and the Federal Reserve Board for failing to process their application for a master account. They claim that the denial in this processing is unlawful and that the standard for reviewing the application is clear and harmful to Custodia, obviously wanting to get an interpretation or an action by the Fed so that they could basically apply or at least appeal that under the APA or under the other recourse they may have. In the complaint, Custodia requests that the court order the Kansas City Federal Reserve Bank or the Federal Reserve Board to decide on their application and take action. Also requests that the court order the Kansas City Federal Reserve Bank or the Federal Reserve to grant a master account to Custodia. Obviously, the complaint alleges that the Kansas City Bank has determined that Custodia is eligible for a master account, but hasn't taken action for a number of different reasons. The Kansas City Reserve Bank in the past had approved one master account for another uninsured state institution, but has subsequently revoked that master account that was granted at that time. As you may recall, when Sarah Bloom Raskin was getting her confirmation hearing for the Fed regulatory position, she had been asked about this master account that had been granted by the Kansas City Fed and her relationship with that bank. Subsequent to that, the Kansas City Fed obviously revoked that master account, and that's also kind of cited in the litigation that Custodia has filed. Also, we've talked a little bit about the Fed's guidance and guidelines around this, and we've talked about the litigation, but there's also been some legislation that's been proposed. The Responsible Financial Innovation Act, for example, which was sponsored by Senators Loomis and Gillibrand in June of this year, would also address how the Federal Reserve goes about granting access to services and master accounts. So this is obviously becoming an important issue, an issue that's being taken up by the court, an issue that's being potentially addressed by legislation, and an issue that the Fed is also trying to address through its proposed guidelines. I think it's something you're going to see a lot more about in the remainder of this year and probably into next year as well. So I think it's something certainly to keep an eye on for a topic that for a number of years had been relatively, I would say, mundane and certainly not all that front page news, but that's changed obviously. The second topic I want to cover today are the FDIC advertising rules. As obviously everybody knows, the Federal Deposit Insurance Act prohibits any person from misusing the name or logo of the FDIC, engaging in any false advertising, or making any knowingly false misrepresentations about deposit insurance or the coverage of deposit insurance. In March of 2022, the FDIC issued a rule to implement the statutory provisions. It seemed at the time that this was something that was probably well overdue. The FDIC had noted in its preamble that there had been 165 instances that they believe of possible misuse of the FDIC name or logo in 2019 and 2020. That's obviously a substantial number. So obviously that justified, I think, the FDIC going about and kind of issuing their rules. I think the final rules, while relatively straightforward, they contain a couple of examples that are worth discussing and worth thinking about. One of the things that's prohibited in the rules is that a person must identify the specific bank or banks at which consumers' deposits may be placed to avoid making any statement about deposit insurance in connection with those accounts a material omission. So obviously there are a number of fintechs and others who have bank accounts that are being maintained by banks, obviously, other than the fintech who's operating the program. You see these advertisements and you see these programs out there all the time. This is important for people to know that who the bank is, who's responsible for the account. It's important for the customer to know, obviously, from a deposit insurance perspective, because all funds that they have on deposit with that bank would be counted, for example, in determining whether they've met the $250,000 maximum potentially for deposit insurance. There's also a concern, though, that consumers need to understand what bank is standing behind their bank account that they might have opened with a fintech or some other partner. Those are important things from the consumer's perspective, and they think they're important from the FDIC's perspective in order to make some of these advertisements that one's seeing in TV and in the print media about accounts being opened effectively by non-banks and how those programs work and providing some additional transparency. The FDIC's advertising rules were effective on July 5th, just last week, and obviously folks are going to have to get all their materials and all their advertising up to speed to comply with those requirements. While the FDIC was introducing its advertising rules, the CFPB also issued a circular in connection with the FDIC rule. They put out that circular on May 17th, and it appeared in the Federal Register on June 14th. The circular takes the position that the conduct, any conduct that violates the FDIC's rule will also be treated by the CFPB as a deceptive act or practice under the Consumer Financial Protection Act. CFPB has indicated that it's concerned with representations about how new financial products or services especially those involving new technologies such as digital assets, are being advertised. Obviously, for things that are digital assets, it's important that consumers understand the limits of deposit insurance and whether those products or not are being covered by deposit insurance. Also, the OCC issued a separate statement noting its concerns with representations about digital assets by digital asset firms and fintechs, and noting that these are now covered by the FDIC's rule. The FDIC, in connection with its advertising rules, also noted that it's still considering some updates to its rules regarding FDIC signage about FDIC insurance, and that's something I think we'll probably also see maybe in the next year or so coming from the FDIC. With a whirlwind coverage of those two topics, let me turn it over to Matt Bisanz, who's going to cover a couple of topics and wrap us up.
Thank you, Jeff. I'm going to cover digital assets and investment funds, two wildly divergent topics, but things that we are expecting to see some action on. And now, unlike master accounts, digital assets are a topic that has been breathlessly in the headlines probably since I started my career about 10 years ago. And everyone has a view on them, everyone wants to talk about them, and in particular, banking organizations remain interested in engaging in digital asset activities, notwithstanding some of the recent market turmoil. And for these purposes, digital assets include things ranging from cryptocurrency to stable coins that are like cryptocurrency, but also a wide range of distributed ledger technologies that can be used to further client goals or further banking operations. However, most recently, where we've seen activity or real movement in bank involvement has been when banks partner with digital asset companies to make the company's products available to bank customers. And so this really is the bank introducing its customers to these digital asset companies. It is not the bank performing or directly providing the digital asset product or service. And this type of introducing arrangement was most common maybe before GLBA with some securities activities or insurance, but we haven't really seen it that much in recent years. And so now we're seeing a resurgence of it for digital asset technologies. This type of introducing model, it may be because some banks are delaying their own digital asset initiatives because of the SEC's Staff Accounting Bulletin 121. There have been some questions around 121 and whether the U.S. banking regulators will adopt it, whether they will impose capital requirements on the assets that are created under the 121 guidance. That has been a significant concern of banking organizations that don't want to set up their own digital asset operations only to have it hit with a punitive and prohibitive capital charge. On the regulatory side of things, U.S. regulators indicated last year in November 2021 that they would issue guidance throughout 2022 on whether specific digital asset activities are permissible for banking organizations. Somewhat surprisingly and dishearteningly, there has been no further public guidance on permissible activities. There have been some rumors that regulators have communicated to banks that they do not want to see digital assets on their balance sheets. They do not want banks involved in lending or margin lending against digital assets. And to date, it seems that very few, if any, banks have engaged in on-balance sheet activity for digital assets. Additionally, the Basel Committee recently issued a second proposal on the prudential regulation of bank exposures to digital assets. This is, again, how banks would hold capital or otherwise hold liquidity reserves against digital asset exposures. The Basel Committee plans to finalize this proposal by year end, and it would impose relatively high capital charges on digital asset holdings, on a wide range of digital asset holdings by banking organizations. This proposal, once finalized by the Basel Committee, wouldn't be a part of U.S. law unless and until U.S. regulators implement it, but historically U.S. regulators have closely followed the Basel Committee on these types of capital charges. Another aspect of digital asset activities is that insured state banks may engage only in activities that are permitted under state law and that are permissible for national banks. And prior to the current administration, the OCC had recognized that national banks could engage in certain digital asset activities, off-balance sheet activities like custody, and currently, based on the current views of the OCC, those activities are subject to prior approval and risk management requirements. But for state banks, there had been no prior approval requirement because they are not regulated by the OCC. In April 2022, the FDIC issued guidance that required insured state banks to provide the agency with prior notice of any digital asset activities. It was issued under the agency's Safety and Soundness Authority, but it also mentions customer protection and financial stability concerns, and we're viewing this as an attempt to maintain parity between national banks and insured state banks. Also, just as a point to mention, as Jeff mentioned, uninsured state banks are generally not subject to federal regulation and therefore are not subject to these particular limits on activities unless they're owned by someone who is subject to federal regulation. Finally, in January 2022, the Federal Reserve issued a report on central bank digital currencies. This is similar to some types of e-money or electronic money. It requested public comment on aspects of CBDCs or a U.S. CBDC in May. It appears the U.S. is still a long way off from deciding whether it will adopt a U.S. CBDC, let alone having the Fed issue one. There are some Fed governors who appear opposed to issuing a U.S. CBDC, and in the press, there's about maybe 5 countries that have launched pilots of it. I think the Bahamas, Jamaica, some other Caribbean islands have launched it. Uruguay might have launched it. China has been considering a digital yen, but it is a far way off from mainstream acceptance either globally or within the U.S., and so we're not expecting to see much action on CBDCs in the second half of the year other than further research and talking points on it. The second significant topic I'll cover that we do expect to see more on is investment fund relationships. And when we talked to you earlier this year about things to follow, we're still seeing concerns with how bank relationships with investment funds are permitted, and there remains some confusion around relationships that are permissible under the Volcker rule, under the prohibition against covered fund activities, versus relationships that are permitted under the organizational law of the bank. And so a bank may have a relationship with or invest in an investment fund only if it is permitted under both the organizational law of the bank, so the National Bank Act for national banks, and the Volcker rule. And there's generally a market practice of banks obtaining legal opinions around the Volcker rule, saying that this is or is not a covered fund, this is or is not an ownership interest in a covered fund. And those opinions are necessary, but they may not be sufficient to demonstrate that the relationship or the investment is permissible under the bank's organizational law, again, be it the National Bank Act or foreign law for foreign banks. And so this is an area that regulators are focusing on, of making sure that these investments are permissible under both sets of legal authorities. The second significant investment fund issue is banks' relationship with funds as borrowers from the bank. And there was a recent speech in May from Acting Comptroller of the Currency, Sue, where he really talked about these types of lending relationships with investment funds, particularly around the concentration risk and underwriting standards that banks apply to these relationships. And he called out the Archegos failure as an example of one where banks had lending exposures to a fund and didn't appreciate the concentration risk, or maybe didn't apply the right underwriting standards to it. And so he said that banks should assess really the appropriateness of lending risk management practices, ensuring that they had proper aggregation of exposures, proper onboarding and analysis of underwriting activities. This is particularly true for borrowers who are high net worth or family office traders, because they may be serviced by a wealth management or private banking division that really is not specialized in the type of lending that involves, say, trading activities in the market, that a private banking division may not be attuned to the same risks that another part of the bank, say a trading desk, would be attuned to in extending these types of credit. And finally, he flagged that there's been an uptick in some types of deals, such as covenant-light deals, interest-only non-recourse loans, some parts of retail banking where there's been a rapid appreciation in asset values, and said that all of these are things that banks should be monitoring as part of their underwriting standards and ensuring that they maintain a high quality of underwriting. So with that, I want to thank you. Well, first I want to thank Jeff and Kerri for joining me today, and then thank you to our audience for listening. We wouldn't be here without you, and we appreciate you tuning in. A few brief reminders. You will receive an email with a link to a recording of today's call. It also will have a link to some materials we have put together on these topics, some talking points that we think are valuable and that you may want to refer to as an easier way than listening to this recording. However, this recording also will be available as a podcast if you'd like to listen to it again. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.